Welcome to the Broken Pie Chart Podcast, episode 176. I'm your host, Derek Moore, and this week we're going to talk about the, I'm going to say the crash in bonds. That's not the right way to say it, but I would say historic declines in bonds. And I'm also going to talk about target date funds. And I spent a lot of time when I wrote my book, Broken Pie Chart, available on Amazon. I'll put a link to it in the show notes. Actually, I don't know why I said just Amazon. It's available everywhere, but Amazon's just as good a place as any to get it. And I wrote about this. My book came out in 2018, and one of the titles of my chapters, chapter 2, was Bonds Past Performance Can't Possibly, or Bonds Future Performance Can't Possibly Equal Past Performance. And I kind of get into why that's the case, given where we are in the interest rate cycle and some other things. And then the next chapter I did was called Target Date Surprise. And really, I wrote it in the lens, really, twofold. Part of it was what happened in 2008, 2009. They actually had hearings in the US Senate on it, talked about more disclosures, the variation in different, the striations in returns. And so I think it's time to revisit that and really ask the question, are target dates more risky than you think? Are they still good? What are they? What do they do? And so, by the way, before we get started, I do enjoy getting emails from people. Derek, DEREK.Moore, MOORE, at Zega Financial. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly, .com. Go ahead and send me emails. A lot of times these episodes are born out of different questions or suggestions I get from the listeners. So we like emails. Send those to us. And again, I'll put a link in the show notes to the book Broken Pie Chart, which, by the way, is why the podcast is named Broken Pie Chart. So JP Morgan, they came out with their quarterly chart pack. I'll try and put a link to that in the show notes as well. And in there, they've done this for equities, meaning the S&P 500. I haven't seen them do this for the US Aggregate Bond Index, or the AGG is the ETF that sort of corresponds to that. But this is the Bloomberg US Aggregate Annual Returns and Intra-Year Declines. And I've only seen this on the S&P. And what they do is they show you in red, hey, what's the most the US Aggregate Bond Index was down, intra-year, and then what did it wind up closing at? And at the close of the quarter, the AGG was down at one point around 13%. And I think this is total return. I believe it is total return, so includes dividends, if I'm reading the notes right here. And so far right now, it's still down around 10%. That is, this chart I'm looking at, you can't see it, but I'll just describe it for you. Going back to 1976, this is the largest intra-year decline. And if the market ended the year here, it would also be the largest decline. I mean, I'm looking, just to give you a flavor of how rare it is for this thing to be down. It was down 3% in the mid-90s. It was down late 90s, minus 1%. My guess is 2014. I can't see it exactly, minus 2%. Last year, it was down about 2%. It's pretty rare. In fact, this is probably 1980-ish. It was down minus 9% at one point intra-year, and then it closed plus 3%. The probabilities, and maybe I'll do these, I'll run the probability of, based upon these returns. What's the probability of this thing being down that much? I almost am certain it will be multi-standard deviations, kind of rare. But I wrote about this in my book, Broken Pie Chart, Chapter 2. And one of the scenarios I kind of went through and outlined was a lot of people point to the late 1970s when interest rates were going up, inflation was going up, and interest rates went up a lot, inflation went up a lot. And you kind of look, and the returns are positive. I mean, there's +3, 1, 2, 3, all pluses in there. And then, 1982, +33%. +33%. That's like a massive equity type return. And part of the reason why you started to see this as interest rates crested and started to come down from 82 forward, I mean, you had +33%, +8%, +15, +22, +15. And, I'm not going to read all these off. And then you look at recently, you had, going this year -10 if it closed. If the year closed right now, it'd be right around -10. Then you have -2 last year, +8, +9, 0, +4, +3, +1. So one of the things that we understand is over the long term, a bond's total return is more driven by how much interest the bond pays, what its coupon payments are. A bond's market value will go up or down depending upon changes in interest rates. Interest rates go down, bond prices go up. So the thing with the late 70s, and I've talked about this before, you had such high coupons that even though, if the coupons if the interest rates were really low like they are today or like they were, coming into this year, you would have seen -15, 16% downturns in something like the US Aggregate Bond Index. But you didn't. And the reason is because all that interest offset it. So I kind of review this because, and by the way, I think I mentioned what a great Labor Day gift this would be. You show up at a barbecue on Labor Day and you come with Broken Pie Chart book, available on Amazon. Go ahead and buy that and buy a couple copies. Give it to your friends on Labor Day and say, hey, look at chapter 2 and chapter 3 and everything that's happening right now is laid out there. By the way, it's also a good indication too. I didn't really pick a date when I thought this would happen. I said at some point, all this, quantitative easing, some of the, the quote unquote money printing, some of the debt levels. I said, well, if we get a year, given where interest rates are right now, that's really low, and then we have any type of inflation and a material rise in rates, what you're seeing in bonds this year is sort of what can happen. But the other thing that I went into was the idea of target date funds. Now, target date funds, I think they're pretty popular. If anyone has a 401k, if you open up your 401k and you look at all the choices, chances are there's going to be like 10 or 15 of these, depending upon the plan, that are target date funds. And basically, target date funds are based upon about the year you expect to retire. That's sort of the guidance in how you pick one of these. Which one do you do? So if you're retiring in 2025, you'd have the 2025. Now, one of the things I said in my book was that, a lot of people don't realize that target date funds are making adjustments and are built not only up to the retirement date. So, for example, if you're retiring in 2025, and by the way, there's a glide path, and the glide path is the closer in you get to retirement, or as you march from the current date to your expected retirement date that you arbitrarily pick, then the more the portfolio goes away from equities and goes into fixed income, i.e. bonds, and short-term fixed income or short-term, more cash-like stuff. And then the idea is, though, you sort of crest and you reach that retirement date, and then the portfolio lives on. So you might say, well, if I retire in 2025, or let's say I retired already in 2010, why is there still a 2010 retirement date fund? Well, because it keeps making adjustments past retirement because it's looking at the longevity and having the assets and reducing risk and things like that. Not a lot of people, and I mentioned this in the book, not a lot of people realize that they keep going on. In fact, the US Senate had hearings after 2008, 2009 about this. And that's one of the things they said, and I put that in my book, and I cited some of the Senate testimony. But the thing I don't think people understood with target date funds, well, there's a couple of things. Number one is if you have a high fixed income portion, and you say, well, usually bonds are fairly safe. I just told you, it's pretty rare for what's happening this year. But given where interest rates were, I think, and this is just me, the way I look at things, a lot of times if an individual goes into, let's say, a bank or anywhere really, and you have someone who's just running historical numbers and they're saying, hey, bonds over the long term, average annual return is this. But guess what's in all those historical returns? All those years 40 years when interest rates were going down. And so the CFA, and I've mentioned this before, CFA society, or there's been some research, and over 10, 20-year periods, whatever the starting coupon rate is for a bond that you hold, typically the average annualized return will wind up being about what the starting coupon was that you held, or the starting yield to maturity, I should say, right? Because you could buy a discount bond or a premium bond, and it has to come back to par, barring defaults. But one of the things I wrote about too is the idea that there was such a difference in 2008 and 2009 on the returns. And in fact, one of the things in a little bit of research that I did, was that many target date funds, they don't all agree on what the right mix of stocks and bonds and all the other stuff is, and at what age you should have the type of investments. One of the graphs I put in, this is on page 39 of the book, shameless plug for the book. But I said, look, select 2010 target date funds, October 07 peak to the March 09 trough. And so this was not 2010. This was close to retirement. And one of the things you see that some of the funds I looked at had anywhere from minus 33% down to, I think one of them I looked at was almost minus 56% down. And one of the things that came out, this is the US Senate Committee on Aging. They had some hearings, and if I find it in the bibliography and in the index at the back of the book, I'll try and link to it if it's still around so you can check out the data. But one of the things they saw was that there was such a variation in the range of returns. And in fact, if we look at 2008, and I'm quoting from the Senate in my book from the SEC.gov documents, the results range from minus 9 loss to negative minus 41% loss at the end of 2008. And so the reason why I bring this up is because there's no set, or at least there wasn't back then, what the allocation should be across funds. Now, there were some target date funds that had a lot of mortgage-backed securities. And we know that 07, 08, 09, that sort of period, there was a little issue with the housing market and with mortgages, right? So I'm not saying that's going to happen now. I'm not making that type of call. But the point I'm making for everybody is, I know these seem really easy, and I get it. I get someone who says, I know nothing about the market. I've got to make some choices in this 401k. And by the way, it's good. People should use 401ks, especially if companies do matches. That's free money for you. And you should at least be contributing. You should contribute a lot because there's tax advantages. But I mean, for God's sakes, please contribute, to get the maximum amount of match from a company, because that is a free benefit for you. But I bring this up because, imagine someone who doesn't really know that much about investing and says, all right, well, I'm this age right now, I'm 40 right now. I think I'm going to retire at 65. I don't really know. So I'm going to pick go out 25 years in the future, and I'll just pick that target date fund. Or I've heard some people say that, their 401k, basically recommends here's the default option on a target date fund. But yeah, I mean, they could be really different depending upon whoever the company is or the firm that's running the target date retirement fund. And also, I would say, I took a look, and I'm not going to tell you what it wouldn't be fair to, because I pulled a couple of these target date retirement funds. And for example, one of the companies here has a mutual fund, a retirement 2025 fund. So we're July of 22. So this would be somebody retiring in 2025. I don't know if they mean, January 1st of 2025. But anyway, so they set up what's called a glide path. A glide path, think about a plane coming down as it's landing. And, it sort of starts to go down in altitude, get lower and lower until it finally lands. Well, that glide path is the adjustments that a firm or a manager will make in one of these target date funds, most likely changing from more stocks, i.e. equity, into more bonds. But I took a look at this one, and the 1-year return as of June 30th was down about 13.5%. And then I looked and I said, okay, what if somebody was in this? And I bring that up because I think the perception would be, and rightly or wrongly, for someone in one of these, hey, wait a second. If I'm retiring in a couple of years, I thought this was supposed to. No, I mean, most of these, I don't know of one that has any hedges in it. But I would surmise to say most of the traditional target date funds, simply a mix of different asset classes, bonds and stocks, right? So I bring this up because, down 13.5%, okay, it's not 20, it's not 30, it's not 40, it's not like 2008, 2009 type returns. Can you imagine if in 2008 you had a retirement fund, or let's say you're sitting there beginning of 2009 and you look up and you lost 50% in a target date retirement fund for the following year. But then I go back and I look, I say, okay, over the last 3 years, the annualized rate of return was 4.6%. Over 5 years, about 5.7. Over 10 years, about 7.9. Okay. Since inception, this one was 2004, about 6.7%. Okay. So, over the long term, but I think what I think is kind of important to bring up is that these don't have hedges on them. They don't. And a lot of these, especially very close to retirement, have exposure to fixed income or bonds. And in a rising rate environment, in an environment that we see inflation, I just want to make sure that we highlight the risk for these. I know a lot of advisors listen to this podcast, and I think this is a good discussion to have with people, to explain what these are, to look at the different holdings. So if somebody comes to you and says, hey, I've got this 401k, and this is the fund that I'm in, and this is the target date year, it'd be good to go and take a look at what the portfolio has. The other criticism I had of target date funds is that, and look, I mean, if somebody's working with a money manager, an advisor, they can try and help look at the broad picture and say, maybe they already have stuff in one account or other accounts that are outside the 401k, and they can get some help on, hey, what's really the best one to do. But this doesn't really, target date funds don't really take into account anything else that you have. And it really just looks at your age. The other thing I'll say is, and I said this in the book, the reality is you're planning for not when you think you're going to retire, but it's a dual plan where, the approximate date you think you're going to retire, but also when you're going to die. I mean, because part of the idea is post-retirement, you're trying to figure out, how long do I need my assets to last and provide income and to provide, and most people, by the way, the good news is life expectancy continues to go up. The bad news is you're probably going to need a little bit more growth than you think because people are living longer. That's good, but the assets have to live longer too. They have to provide income for longer periods of time. So these are just some of the things I think are critical to think about. The final thing too is these target date funds really don't take into account how much in assets somebody has. In other words, someone with a good deal of assets who's been fortunate, has been able to save a lot, has a lot in their investment accounts, they may not even need to take the risk of their target date retirement fund. That might be because they already have the money. And why put it at risk? If you've got a substantial sum of money. The other thing that comes into play too is, what about health expenses? What about bringing those things in? And the other side of it is someone who has, doesn't have a lot of assets towards retirement. They're going to need more growth. And so they're going to run out of money much quicker. And so unfortunately, they do need growth. But these target date funds, they don't take that into account. And I think, these are all questions to get. I think they are well-intentioned. I think they're misunderstood by a lot of folks. And I think this is where people with advisors can really help talk their clients through this type of stuff. And, for those that are just investors, or I would take a look at the exposure in some of these funds that you have. And then also think about the level of assets that you have. So there's a lot more that goes into it than just age. And that's I think, the closing thing I'll say. When you're trying to do a one-size-fits-all just purely by age, not by asset level, not by other things that you have, not by life expectancy, not by your certain situation. They're really well-intentioned, though. And by the way, I think it's a really good thing that a lot of companies are auto-enrolling people in 401ks. It is really good because the sooner people do that, as all of you know, the more you invest and the younger you do it, the more years, the less you actually have to invest because you get that compounding. So I'm not going to say that the alternative is to not invest in 401ks. And I think for younger workers, where the target date funds do properly have, a lot more equity exposure in there. Look, it's probably fine. And until you get a good substantial bit of assets, then maybe you start looking and being a little bit more strategic about the types of different funds that you use in there. But anyway, I hope this is helpful. And I think given where bond returns are this year, I haven't really heard a lot about people complaining about target date funds like we did in the aftermath of the great financial crisis. But we'll see. We'll see. And I don't have a crystal ball on interest rates or inflation. I can tell you that inflation is expected to still be above 8%, according to the Cleveland Fed Nowcast, for June's numbers, which will come out next week or the week after July. And then still above 8% for July that will come out in August. So what does that all mean for interest rates and bonds? I think this year is showing that given how low interest rates were and still are comparatively, there is interest rate risk in a lot of fixed income, and you just have to understand it. All right, folks, we'll leave it there. Shameless plug, I know, this week for the Broken Pie Chart book, but if you do pick it up, let me know how you like it. And I think, although I wrote it a few years ago, it really lays out some of the scenarios that are in there. And if you want to get an understanding of how we manage risk in portfolios, go ahead, derek.moore@zegafinancial.com. Love to hear from you. We can walk you through that. All right, everyone, have a great week, and we'll talk